Hello, welcome to another episode of In Focus. I'm Mike Gassewitz, the CEO of IAIC, and today I'm joined by Brian Durno, one of our portfolio managers. Hey, Brian.
Hey, Mike.
Great to have you on. A little while back, we were all together, and you gave the group, all the PMs and some of the advisors, some of your thoughts on the inflation front, and I thought that was fantastic. And again, I thought it'd be something clients would like to hear. What are our thoughts? What are your thoughts in terms of what we're seeing from an inflation perspective? Obviously, markets very volatile. Not just the equity markets. We're seeing what's happened with bonds, given what central bankers are doing, trying to control this current state of inflation. So I thought maybe what we could do is flash back a little bit to the 70s. I hate to admit it, but part of my youth was through the 70s. And so, even as a kid, you kind of didn't know, I use this anecdote that I live in a neighborhood, is a subdivision, and there was this place, we called it the Field. And it was the Field. It was this empty lot of about, probably could have been 5 or 6 houses that could have gone in there, but nothing happened for the decade we grew up. It was the Field. That's where we all hung out. Little did I know that was basically a byproduct of stagflation. Inflation was taking off, and yet nothing was really happening from, basically the economy was somewhat stalled. Anyway, I thought maybe we start there. Let's start the 70s and 80s, and maybe you could talk to us about what we saw back then.
Sure. Yeah, well, thanks for having me here. It is actually an interesting reference point because the 1980s was the last time the central banks were very, very aggressive in their approach at attacking inflation, especially the Volcker area, from 79 onwards there. It really got aggressive, just like it is now in terms of the pace with which interest rates are rising, nowhere near to the same level of inflation and interest rate increases, but still
Right.
very much a fast pace. So one of the things that you look at in that historical period was inflation in the 80s and the 70s. It was really a generational battle against inflation. It started well before the 80s when Volcker came along. It was a good decade or so of this battle. And it took a long, long time for the Federal Reserve to be successful at knocking back inflation back then. And so that period, actually, nominal GDP wasn't terrible. And corporate earnings growth actually wasn't that terrible either on a nominal basis from a profits perspective. But the one thing that really affected markets, and this is something that we watch carefully in the precedent now, is how the asset valuations, the prices that people were willing to pay for assets, declined pretty much for an almost 15, 16 years as the Fed battled inflation. So multiples that we call the price that you'd pay for $1 of earnings,
Right.
were around 23 times, and they kept dropping to about 7 times in 1982. So that was sort of a headwind for markets.
You use the term a generation. So it lasted a while. And obviously, inflation is from an economics perspective, not a great thing for a consumer or possibly an investor to live through. So how do you compare, basically that generational period we saw back then to what we're seeing today?
Yeah, there's some, I guess, early recognition that the Fed and central banks generally this time around are much more courageous in their attempts at dealing with inflation. And before Paul Volcker got his hammer out, there was a few fits and starts in terms of the level of confidence to attack inflation. And so far this time around, that seems like that's not the case. There's a real concerted effort to deal with inflation. So there is some, confidence that the central banks really want to get this thing under control and not have a generational battle against inflation that just keeps on rearing its ugly head. Inflation rates even now in the States peaked at 9.1 and are down to 7.7. So certainly that's not a level that we're comfortable with as participants in the economy, but it's better than it was. So
Right.
there's some mild evidence that it's getting better.
Right. And in terms of the central bank having that ability, to try and tame inflation, I recall you throwing out some metrics that would give us some optimism in terms of the ability for it to work, basically.
For sure, there's some real differences between now and then that I think are worth pointing out. It's always great to study your history and understand what happened in the past. But just like everything in history, no two setup periods are exactly precisely the same. So you can't use history as a prescription for the future. But it is informative to look at some of these differences and really concentrate on what I think is probably three really important parts that are different between now and then that might make the Fed a little more successful than they were in that prior period. In those three areas, I put them in three buckets. One is the absolute level of debt in the economy, not just households, but also governments. That, first of all, makes us much more sensitive to rising interest rates. Not only households, but also governments will be constrained in their budgets because of the amount of interest they'll have to pay on the debt. And the debt levels compared to the 80s are materially higher. I mean, on a chart, it's a noticeable, quite a significant difference in the amount of debt in the economy now. So the central banks, I think, will be more, or at least we should start to see some more impacts of these rate increases much sooner than we did back then.
Well, heck, we're even seeing it now in the housing market, right? As soon as the interest rates started going up, definitely seeing it slowing down, and in many geographies, the price is actually going down as well.
That's right. Yeah, the interest sensitive components of the economy are already showing these cracks. They're already showing the evidence that they're being successful at dampening demand. And housing for sure is one of those things. And consumer confidence is another one. You also have this small wrinkle. Because of COVID, governments generally supported their citizens by providing them with lots of money to deal with that. And so the result is that you have a surplus of savings that you didn't have that helps you deal with some of these, problems with inflation, and even, the cost of consumer goods, these kinds of things. You're able to manage that a little bit better because you have more savings than you would have had COVID not happened. So there's a few little wrinkles that make this period much different than it was in the 80s.
Any other metrics that give you a reason for all of us to be optimistic?
Yeah, for sure. The two other ones would be demographics, and the third one is GDP growth dynamics. So maybe I'll just spend a second or two on those. But demographics, the profile in the 60s, 70s, and 80s looked materially different than it does today. You can run this measure multiple different ways, but if you just think of the percentage of the population that's over 65, let's call it the G7, it is significantly higher today. And so there's also correlations between an aging population and slower GDP growth. So that's something that is, again, a source of difference, and the demographics aren't in our favor for easy tailwind GDP growth behind us. And actually, when you look at the level of GDP growth heading into inflationary periods, the level of GDP growth in those earlier periods in the 60s and 70s, is more like 4s and 6s. And so the lead up to this period, GDP was growing, 1s and 3s. So the dynamic of the actual economy wasn't growing nearly as quickly. So all of those things inform you that the central bank actions could be felt a little bit sooner than they were back then.
All right. So basically, your best guess right now in terms of, is this a generational issue we're facing, or is this something relatively short-lived, this current state of inflation?
Right. Yeah, I would, when we think about portfolio construction, we try actually not to place a material bet on being absolutely right or wrong about this point of view, although it's very, important to pay attention to this macro overdrop. But at the end of the day, our defense usually lands on the solid companies that we're buying, and whether or not they have the ability to pass through these cost increases to their consumers in a measured way to protect their profitability, and making sure their balance sheets are strong so that the interest expense doesn't threaten their business. And so those kinds of basic blocking and tackling is an important part of the portfolio design that we have, so that we don't have to be perfectly right about how long. Like, we don't have to say it's going to end on a certain day and then point our portfolio in a direction that suggests, well, it's binary now. We're either going to be right or wrong. It's much more of a diversified approach that we would take. But if I had, if you did ask me, so I have to kind of say, I'd probably be guessing that it wouldn't be a generational battle against inflation. I would point to the debt levels, the demographics, and GDP growth dynamics as the three reasons why.
All right, good stuff. And we'll try not to hold you to it, but based on based on my history of living through stagflation, it's especially then when in the early 80s, before they did get it under control, it was tough. It was tough to find a job because you had, high inflation, and yet you had a high unemployment as well. So let's hope we don't see those days come back. And it's interesting, even just maybe more than a few months ago, the big concern was actually deflation. That's probably even something that's even more difficult to an economy. So luckily we're not facing that. Brian, thank you so much for this.
Thank you, Mike.
And folks, if you have any questions, don't hesitate to reach out to your advisor or your portfolio manager. Take care.